Hello, I'm Noel Lim on ASEAN Speaks by Maybank. Our analysts discuss how ASEAN is closing year to date and their 2023 outlook amidst possible actions by the Fed. Portfolio Strategist Ong Seng Yao moderates the call.
Good morning, everyone, and welcome to the GB call. Since October, markets have been trading on a bright note following the release of slower US inflation and PPI data sets. But last Friday's strong US jobs and wage data only confirmed that the labor market trends, the strong labor market trends, are not going away anytime soon. And this could invariably complicate the Fed's abilities in engineering a soft landing. Going into 2023, we will now be speaking with our strategy team, which has just published their outlook for the year ahead. Our focus will be on economics, FX, and fixed income this morning. So without further ado, let me go to the first speaker, Suhaimi, who is our chief economist for Malaysia. Suhaimi, very good morning to you and to your team. When the Fed Chairman Powell spoke at the Brookings Institution last week, he basically sent two messages that gave markets a fair bit of hope. One was that the Fed was slowing down the pace of interest rate hikes as early as December. And two, it didn't want to see job losses. The Fed clearly acknowledges that the labor supply is going to remain tight. And this means that the only other major lever that the Fed has in its disposal to slow jobs growth down is to basically slow labor demand. This is the way that it plans to basically engineer a soft landing. Do you think the Fed is going to be able to do this and at the same time achieve a mild recession? Suhaimi?
Good morning, Seng Yao. Our base case for US is inflation moderating to 4.2% next year from 8.1% this year, and GDP to virtually stagnate next year, expanding by just 0.3% against estimated 1.7% growth this year. So I think Fed acknowledged there will be impact on growth from the cumulative interest rate hikes of 375 basis points so far. Hence the signal that it will raise interest rate by a slower pace of 50 basis points at the next and final FOMC meeting for this year on 13-14 December. This is after 4 consecutive rounds of 75 basis point hike between June and November. Recession is expected to be mild this time around because of factors like the surprisingly resilient job markets that you mentioned, buffer to consumer spending from drawdowns of excess savings that were built up over the past couple of years during the pandemic lockdowns, plus stimulus checks, as well as the lower debt level this time around. So for example, US household debt to GDP is 76% now, compared with almost 100% in 2007, 2008. And even the financial sector debt to GDP is also at same level, around 77% now, versus 120% in the run-up to the global financial crisis. So I think this time around, the chance of achieving a mild recession is there in our opinion, and it is factored in our forecast.
Okay. Suhaimi, when we dial back a few days and we look at, the media, especially on Bloomberg, Lawrence Summers was quoted as saying that he believes that the terminal rate at 5% is not going to be adequate in terms of quelling this inflation. In your outlook for the economy, and I think you mentioned earlier that, rates have still a way to go into next year. Do you think that interest rates will peak by first quarter? And what are the top most important factors to consider here?
Well, we expect US Fed fund rates target range to peak around springs next year at 5% to 5.25%. This is as inflation is expected to start heading in the right directions as far as Fed is concerned towards its 2% target more conclusively by then. We're already seeing signs of monthly inflation rate peaking, and together with other indicators showing commodity prices rolling over, as well as indications that the supply chain bottlenecks dissipating and easing. But of course, inflation numbers at the moment is still well over 2%, despite showing signs of peaking. So I guess that justifies a few more rounds of lower quantum of rate hikes. So I guess from that perspective, we think our view right now of where the terminal rate for Fed fund rate is there. And bear in mind, don't forget, there is another tightening in Fed's monetary policy going on right now, which is quantitative tightening since June, which reversed the quantitative easing. So Fed is also shrinking its balance sheet, or to put it another way, it's winding down the money printing machine, which, as you know, from economic theory or convention, when there's too much money, it is also inflationary. So there is actually a couple of instruments at Fed's disposal to deal with the issue of inflation.
Right. Okay. So I mean, and I believe you would agree with me that all of us, including everyone in the audience, have heard this phrase before that, this time will be different. I'm saying this, because when we look back at when Paul Volcker was appointed by Jimmy Carter as Fed chair, 1979, he took interest rates to about 18% in the first cycle. And then the US economy entered into a recession. But shortly after that, the Fed funds rate started falling, which of course limited the effectiveness of the Fed's anti-inflation drive. Then Volcker reacted by tightening again, which brought about a second and more severe recession. What do you think is the risk that Powell will make the same mistake as Volcker?
Unlikely in our opinion. I mean, Powell's Fed already made the mistake of thinking inflation was temporary, but it turned out to be more persistent, hence the aggressive tightening so far. And once our expected terminal rate of 5% to 5.25% is reached next spring, we reckon Fed will keep interest rate at that level for the rest of next year to avoid the mistake of premature easing. And again, I repeat, Fed's policy in dealing with inflation this time around is not limited to interest rate instrument alone. There is the balance sheet reduction or quantitative tightening.
Thanks, Sohaimi, for that view. Harbin, let me turn the spotlight over to you right now. When you look at ASEAN and inflation in particular, I believe your call is also that it is going to peak soon for the region. What's driving this inflationary impulse, and which countries are basically showing the most rapid trends?
Hey, hi, morning, Singyal. So I think energy prices have come off quite a bit, right? Oil prices was near 140, now it's closer to 90. Food prices, according to UN Food Price Index, has also fallen quite considerably from the worries of 8-9 months ago. And there are signs that some of the supply chains disruptions have been dissipating. So when you look at freight rates, for example, they've plunged actually from their highs. So all this is pretty encouraging. In fact, we already see signs that inflation may have peaked in some of the countries in ASEAN. In Singapore, for example, it looks at that the headline and core inflation may have peaked in September. In Thailand, it looks to have peaked in August. And surprisingly, in Indonesia, even though there was a fairly big hike in fuel prices, it looks as if headline inflation may have also peaked in September as well. So I think there are encouraging signs, and we saw some of that as well in the US. So I think that will provide quite a bit more room for the central banks, especially going to next year, not to have to hike as aggressively. The job market in ASEAN, remember, is generally not as tight as well as the US. So the wage pressures are not as intense, perhaps with the exception of Singapore. So I think there are encouraging signs, that we are past the peak for inflation. It's just that what Sohaimi has highlighted, that even though it will come down, it probably come down, fairly slowly. It could be sticky on the downside, and probably will stay above most of the comfort ranges for the central banks.
Right. No, to that point also, that rates will likely remain elevated for some time. That even if it comes down, right, I think the pace will likely be slow. But should this happen, should this deceleration on the interest rate cycle happen, especially in ASEAN, do you think that the rate cuts here will begin sooner rather than at the same time with the developed markets, especially in the US?
We doubt that the ASEAN central banks can move ahead of the Fed in cutting rates, and because we expect the Fed to hold rates for at 5 to 5.25% for all next year. I don't think there's any rate pivot next year, and only start cutting in 2024. I don't think the ASEAN central banks can move first. And then the second point is that just bear in mind that most ASEAN central banks never really hiked as aggressively as the Fed. So actually, even in 2024, most of the policy rates in some countries, including Thailand, Malaysia, and Vietnam, are closer to the neutral range. So there's actually not that much room to cut. The ones that will see interest rate fall in 2024 when the Fed starts cutting is probably Philippines, Singapore, and somewhat Indonesia as well.
Thanks. That's very insightful, Harbin. Let me bring in the bonds team right now, because obviously with the interest rate outlook, there will be a lot of questions in terms of how credit markets will likely perform. So Mani, over to you. On ASEAN credit, I believe in general that ASEAN bond yields basically lag the synchronized global fixed income sell-off this year. On a relative basis, which market in ASEAN leads and which lags in this sell-off?
Hi, morning, Sing Yao.
Hi.
Yes, unlike the sell-off in UST, which has a negative return of about 12 to 13% year to date, EM Asia local currency government bonds have outperformed, though it varies from one country to another. For us, China stood out with a year-to-date gain of around 3%, followed by Indonesia with around 1% gain. Malaysia had a small loss of 1%, while Singapore, Thailand, Philippines, and South Korea had negative returns of 6 to 10%. But moving into 2023, we think government bonds will play an important role as a defensive asset class that outperforms in a downturn. We have a bullish outlook on US Treasury. So in a cycle where the Fed is tightening into a slowing growth momentum with rising probability of recession, we think the 10-year UST can peak well below the terminal rate. We also have a bullish outlook on MGS, on expectation of growing global macro headwinds and slower domestic GDP growth next year. So BNM has may hike by another 25 pips, but we think the hike cycle is nearing the tail end. Supply-demand profile of ringgit government bonds appears neutral. We also have a mildly bullish outlook on China government bonds, SGS, and a neutral outlook on Indonesia government bonds.
All right, thanks. Mani, on that point on the MGS, this curve, the MGS curve has bull flattened since your last review in September. What is your view between the shorter tenures and the longer tenures, the 3, 5, and particularly the 30-year tenures in this case? Could you walk us through, please?
Sure. So domestic interest rate cycle has reached the advanced stage of tightening with the OPR at 2.75% in our view. But the 3-year MGS spread over OPR remains wide at around 100 bips. Even if we assume a larger than 25 OPR hike next year, the 3-year MGS OPR spread will still be wider than the long-term mean of around 20 bps when the OPR was in the range of 3 to 3.5%. So we think the risk reward of 3-year and 5-year MGS yields at 3.90% and 4.25% respectively are favorable. And we prefer the 5-year MGS as the 3-year, 5-year MGS spread is slightly wider than historical mean during the late stage of rate cycle. So on long duration, we think MGS long duration provides an ideal hedge in ringgit asset allocation against US recession risk, as global rates dynamics may unexpectedly descend from late cycle into end of cycle pricing. We don't think US interest rate can stay structurally high at above 5% in the next couple of years. This year, the bond route had opened up buying opportunities for Malaysian government bonds at yield level of above 5%. And we think this 5% threshold remains relevant given the abundance of domestic absolute yield seekers.
Great, thanks, Mani. And I'd like to basically come back to Harbin right now on the ASEAN's economy. Harbin, in your report, we see that you are looking at also several other factors to support your bullishness within for ASEAN's growth. And the point to note here is that you are actually more bullish on ASEAN than you are on China. We've covered a fair bit earlier on inflation. Could you walk us through your views on some of these factors that you're watching regarding ASEAN's bullishness?
Yeah, so we think ASEAN's growth will be still pretty resilient, compared to the rest of the world, especially when US, Europe are at risk of slipping into recession. China will recover somewhat because of reopening. So we are looking at 4% growth next year. That's up from the 3.3% projected for this year. So that's slightly better, in part because of the reopening. But we believe that there'll be starts and stops. The vaccination rates for the elderly is still low, and there could be an exit wave of infections and deaths, and as China deals with this reopening. And don't forget that we still have the ongoing property crisis. The property sector is pretty large, including the related sectors. And this debt overhang is not going to just disappear anytime soon. So I think that keeps China's growth in check, even though it's recovering. And I think ASEAN's growth will actually be stronger than China for a second consecutive year. There was actually quite a bit of skepticism when we made the point that it will be higher than China's this year, because China's growth has been higher than ASEAN for the last 30 over years. But ASEAN's growth is still going to be cushioned by the reopening tailwinds, and there's still some room to go there. And some of the more structural arguments, the shifting supply chains, especially on the manufacturing side, coming towards ASEAN, because this US-China rivalry is just not going to go away. We've seen the FDI increasing in a number of ASEAN countries. There's also the encouraging signs that intra-ASEAN trade is actually growing still at over 30%. Bear in mind that exports to almost everywhere else is slightly towards zero. Intra-ASEAN trade is about 19% of total trade, so that helps to buffer this global slowdown as well. And there's also encouraging capital flows that's been coming into ASEAN, not least from Hong Kong and China, which also strengthens Singapore's position, I think, in particular as an international financial center. Some of this is driven by structural factors, US-China rivalry, but also stricter national security regulations in Hong Kong, and there's still signs that this will probably continue.
Right. Thanks, Harbin. With this focus on China, one needs to also address the importance of tourism, because as the gates open, many of these markets, especially in Thailand, will likely benefit. And the point here also is that tourism arrivals now are probably just about 50% of pre-COVID levels. So I'd like to now bring in Julia to talk a little bit about Thailand's economy and the impact that tourism will have when things reopen. So Julia, if we look at Thailand, how positive has that turned, especially from a current account perspective?
Morning, Seng-Yao. Morning, everyone. Yeah, so in Thailand, tourist arrivals have risen to around 1.5 million in October, and that's mainly boosted by regional countries like Malaysia, Singapore, and India, whereas China tourists are only at 4.3% of their pre-pandemic levels. But rising tourism receipts have boosted the current account balance. It's in its second month of surplus at 840 million in October, from 620 million in September. And the services balance has also improved thanks to lower freight costs as container shipping rates have normalized to pre-pandemic levels. So this improvement in services balance has helped to offset the narrowing goods trade surplus. And BOT is looking at visitor arrivals to reach 22 million in 2023. That's still slightly more than half of pre-pandemic levels of 40 million. And we expect the current account to continue improving. In 4Q this year, we are looking at close to 2% of GDP surplus compared to nearly 6% of GDP deficit in the third quarter, and gradually improve to 2.5% of GDP in 2023, thanks to the tourism rebound and the normalization of freight rates. And that should help to support the Thai baht as well.
Okay, great. On that point on the Thai baht, I think it's also timely for me to bring in Andy, our FX strategist. Andy, this Thai baht is basically the worst performing Asia currency since the pandemic. I think it's down about 17% since that point in time. As Julia mentioned, this currency could be a beneficiary of the potential rebound in China's outbound tourism. Would you be long the Thai baht, and what would you long and short this trade against?
Hi, morning, Sengel. Yes, I think like what Julia mentioned, I think one of the key sort of variables to look at in terms of Thai baht perspective is on the current account side. I think the swing in the Thailand's current account surplus to deficit was due to absence of tourism inflows, particularly from China, and I don't think that will change in a significant way anytime soon. And that has dragged also on the back of a surge in oil import bills that has amplified its trade deficit. But in recent days, I think Thai baht has actually been boosted by signs of the China reopening. The question is whether that is still tentative or sustainable, but there is some signs of tentative improvement in its current account. I think softer crude oil prices, I think Harbin mentioned earlier that oil prices have fallen towards 90 from higher levels, 140. And at the same time, incremental loosening of China's COVID management could see spurts of a return of Chinese tourists potentially next year or even 2024 back to Thailand. Overall, I think the asset-wise, I think that could be positive for Thai baht. So back to your second question, I think we prefer to actually long Thai baht against the dollar and also renminbi on dips as the two things. One is US economy is likely to see considerable slowdown in 2023. And at the same time, China's current account surplus could deteriorate as domestic demand and outbound tourism probably picks up in the next in the middle of next year, towards the end of next year.
What's your view on the renminbi then in terms of over the next 6 months or so? Yes, it's for the fact that you just mentioned that it's quite unlikely that renminbi can strengthen too much because of its current weaknesses. And at what rate are you looking at then?
Indeed. So in our view, we look at the glass half full view for now in terms of China, in the hope that there could be further easing of restrictions. It's definitely an upside risk on that front. In terms of further easing of restrictions in the first half of 2023 at the earliest. Indeed, some elements of yen sentiment over the past week has turned positive in terms of first signs of the easing. Our view is, I think there could be some sort of upside on renminbi in the interim, given the near-term rally. But actually, we look for yuan to actually weaken against non-US dollar trading partners, in part because expectations of the revival of outbound tourism and domestic demand, which could increase imports and weaken its external balance. Our renminbi forecast for over the next 6 to 12 months, we're looking at renminbi possibly to end next year around 680, 685 to 680 possible range. So essentially going to be a gradual CNY slight appreciation, but it's going to continue to be weak into the first half of next year. So it's probably going to hover around the 705 range, and the max up to 695 potentially by middle of next year.
Okay, all right. Thanks, Andy. Andy, I just have 2 more questions for you, and we'll just stay on FX until the end of this call. Of course, with the currency markets focus and spotlight last week, no one can deny the fact that the yen is the one that markets are looking at right now. Do you think the yen is likely to hold its current run at this moment? I mean, the US dollar yen pair has basically fallen nearly 10% in just over 30 days. It's capped by intervention and, of course, the growing signs of a turn in the broader trade-weighted dollar. Do you think this run can basically continue?
I think our view, just to give you the share of our forecast view, we think it would continue probably in ups and downs, but probably end next year closer towards 125 to 120 to 125 range. Typically, it's essentially because dollar yen has actually fallen due to the growth downshift and softer US inflation reports that has come out. That has allowed for a significant correction in the US Treasury yields. And I think you've heard from Manyi in terms of the bond market front. And a shift of focus from inflation to growth concerns could continue to keep US Treasury yields on the decline. And that would actually allow for more room for dollar yen to fall. But we might not be a straight line drop for dollar yen, but softer growth outlook could also cap oil prices and mitigate all related drags which has typically led to the dollar yen a bit higher as well. So those sort of combinations of growth outlook, oil prices, mitigating all related drags and all that would actually help to sort of keep a cap on the dollar yen moving upwards, I think, in 2023 compared to what we've seen this year. So we are forecasting up end the year about 120 to 125 range.
Right. And just a sub point on the yen, this kind of strengthening back up to 125. Is this the same trade that happened in 1998? When the yen went towards 150 and then came back all the way down again. Is this exactly the same trade?
It's slightly different. I mean, I wouldn't say it's exactly the same, but I think the context of the environment is a bit different. I think what Sohaimi shared in terms of the macro outlook, we are in an environment where the inflation trajectory, I think, is still going to be sticky into 2023, but it won't be as significant support on inflation as what we saw in 2022, but it will remain sticky. So his question is, I think policy is still a bit uncertain. There's still going to be concerns about inflation stickiness into 2023. But the concern next year, I think, is going to be the softer growth outlook. And typically in that front, I think together, coupled with the oil prices being capped, would help dollar yen, I think, in 2023. So I think there's a slight difference. I think confluence of different factors which may make 2023 a bit different if not in a marginal way.
Okay, Andy. Andy, we just have time for one more question here, and I'd like you to help us address this last point over here. Can you tell us your view on the ringgit and whether you're bullish on the currency?
Yeah, we remain a bit cautious, still cautiously optimistic for ringgit. We are looking at ringgit potentially to strengthen back, dollar ringgit to strengthen, dollars to further fall towards 405 to 405 levels by end of next year. I think it will strengthen considerably and in a sustained way only next year. So probably into the second to the end of next year. Near term, I think ringgit has seen some appreciation against dollar. I think retracement in the US Treasury yields, recently the China reopening plays and expectations of a China recovery. And at the same time, our view is I think ringgit looks relatively cheap in real effective exchange rate or trade weighted basis, and trade balances actually still remain benign. The other element, the political uncertainty factor, which have dampened sentiment somewhat, has actually receded following the recent election. So I think we have to factor that in. However, for now, we actually try to put in some risk premiums on the ringgit to some extent, remain cautious until signs of, in some ways, credible policy-making direction emerging. And also we feel that US dollar support actually will soften to some extent only from second quarter of next year. So if you factor all that in, we think there will still be at least another 1 to 2 quarters before ringgit probably strengthen in a sustained way towards the end of next year. On balance, overall, we see high likelihood for ringgit sustained recovery and some traction to only come in towards the latter part of the first half of 2023 and end the year closer towards 4. And we'll be surprised. We wouldn't be surprised if it slightly falls below 4 by end of next year.
Great. Well, thanks, Andy, for helping us end the show today on that high note. With that, thank you. Have a great morning ahead and happy hunting. Thanks.
For more information, check out our report on ASEAN Macro Year Ahead, a Defensive Harbour. I'm Noelle Lim on ASEAN Speaks by Maybank.